Most investors still want to believe the hardest part is behind us. They want to believe inflation is fading, rate cuts are only a matter of time, and the market can keep climbing as long as earnings stay decent. But the story has become more complicated. Because right now, oil is rising again, bond yields are still elevated, and some of the biggest institutions on Wall Street are already adjusting to a world where rates may stay higher for longer than investors hoped. At the same time, U.S. stocks still look surprisingly confident, with strong earnings expectations and large firms like BlackRock upgrading U.S. equities even as energy prices and geopolitical risks remain in the background. That combination is exactly what makes this moment so important. So this video is about one simple idea. The market may still be underestimating how connected these forces really are. Oil is not just an energy story. Inflation is not just a macro story. Bond yields are not just a fixed income story. And earnings are not just a corporate story. Together, they shape the entire pricing environment for stocks, bonds, currencies, and risk appetite. That is why I think one of the most useful ways to understand markets right now is through a single question. What happens if higher for longer is back? Let's start with oil because that is where the pressure is easiest to see. As of today, Reuters reports that Brent crude has moved above $100 a barrel again, while physical oil delivered into Europe has pushed close to $150 a barrel in some cases as the Strait of Hormuz crisis intensified. Reuters also reported that Brent had surged by around 8% in one session to roughly $102.5, and OPEC has now cut its second quarter 2026 oil demand forecast by 500,000 barrels per day because of the disruption tied to the Iran war. Those are not small moves, and more importantly, they are not just headline moves. Reuters says the closure of Hormuz has blocked millions of barrels from the market, while OPEC's own assessment points to a second quarter demand expectation of 105.07 million barrels per day, down from 105.57 million previously. OPEC Plus output also fell sharply in March, down 7.7 million barrels per day to 35.06 million, according to Reuters' summary of OPEC data. That matters because oil is still one of the fastest ways inflation risk gets reintroduced into the system. When oil rises sharply, the effect is not isolated. It flows into transport costs, logistics, industrial margins, airline pricing, consumer sentiment, and inflation expectations. And once inflation expectations start moving higher, central banks become more cautious. This is why the oil story matters even to people who think they are investing only in technology stocks or broad market indexes. Because expensive energy changes the discount rate story. It changes the inflation story. And eventually, it changes the valuation story. That brings us to rates. One of the easiest mistakes investors make is treating rate cuts like a one-directional process. They assume the market has already moved beyond the inflation scare and that the remaining question is only how soon central banks will cut. But Reuters' latest reporting suggests the bond market is not nearly that relaxed. A recent Reuters poll showed the U.S. 10-year Treasury yield is expected to remain around 4.26%, even after all the recent volatility. At the same time, Reuters reported that Wells Fargo no longer expects the Federal Reserve to cut rates at all in 2026, while Citi pushed its expected timing for cuts back to September, October, and December instead of June, July, and September. That is a big shift, because in markets, timing matters almost as much as direction. If investors are pricing in a softer path for rates, but the actual path stays tighter for longer, then the repricing can be painful. Not dramatic all at once necessarily, but persistent. And that kind of persistence is often harder for markets to absorb than a single shock. This is also why rising yields matter more than many retail investors realize. Higher Treasury yields do not just affect bonds. They affect how investors value future cash flows. They affect mortgage rates, credit conditions, business borrowing costs, and equity multiples. They can make safe yields look more competitive relative to stocks. And when yields stay high at the same time as oil stays elevated, investors start asking a more uncomfortable question. What if inflation does not cool fast enough to justify the market's optimism? That question is exactly why today's market is so interesting. Because on one side, you have reasons for caution. Oil is elevated. Geopolitical tension is real. Inflation risk has not disappeared. Rate cuts are being pushed back. But on the other side, the market still has reasons to stay confident. Reuters reported today that BlackRock upgraded U.S. equities from neutral to overweight, citing resilient corporate earnings, especially in technology, and a view that the economic impact of the Middle East shock may remain contained. Reuters also noted that the S&P 500 has rebounded nearly 8% from its March 7-month low, and that first-quarter earnings for S&P 500 companies are now expected to rise 13.9%, up from 12.7% before the conflict. BlackRock also pointed to expected 43% earnings growth in tech in 2026, compared with 26% the previous year. Now that is where the real tension sits. The market is not ignoring risk. It is effectively saying that earnings can absorb it. That corporate America, especially large-cap technology, is strong enough to keep markets supported even if the macro backdrop gets more difficult. And to be fair, that argument is not irrational. If earnings stay strong, margins hold up, and large-cap firms continue to compound cash flow, then stocks can absolutely remain more resilient than people expect. But there is still a big difference between resilience and immunity. That difference matters. Because if energy remains high for longer, then some parts of earning strength could start to erode. Transport costs rise, input costs rise, consumers become more cautious, and the good inflation narrative can quickly become a margin pressure narrative. In other words, the same market that looks strong at the index level can become more fragile underneath the surface. This is especially important in a market where leadership is already narrow. When investors become more dependent on a relatively small group of companies to carry sentiment, valuation mistakes become more dangerous. Because then the market is no longer just discounting growth. It is discounting nearly perfect execution under a messy macro backdrop. That is where repricing risk comes from. Not from the idea that AI is fake, not from the idea that earnings are fake, and not from the idea that the economy is collapsing, but from the possibility that expectations remain too clean for a world that is becoming messier again. And that is where higher for longer becomes the key concept. If oil stays high, inflation stays sticky. If inflation stays sticky, central banks stay cautious. If central banks stay cautious, yields stay elevated. If yields stay elevated, multiples face pressure. And if multiples face pressure while expectations are still high, markets can reprice even without a recession. That is the chain reaction investors need to think about. Not because it guarantees disaster, but because it changes the burden of proof. In a lower rate world, investors can be more forgiving. They can pay more for growth. They can tolerate more uncertainty. They can tell themselves that time and liquidity will solve most things. In a higher for longer world, that gets harder. Capital becomes more selective. Valuation matters more. Balance sheet strength matters more. Cash generation matters more. And narrative alone matters less. That shift does not hurt every company equally. In fact, it can actually strengthen the relative position of the best businesses. Large, profitable companies with pricing power, strong balance sheets, and durable demand may look even better in a tougher environment. That is one reason why institutions can stay constructive on large-cap U.S. equities while still acknowledging macro risk. But it also means the market may become more divided. The winners may keep working. The weak balance sheet names may not. The firms with pricing power may absorb cost pressure. The firms without it may get squeezed. The companies tied to structural trends may remain resilient. The ones reliant on easy money may struggle. That is why I think this is a stock picker's environment disguised as an index environment. At first glance, it looks like a simple macro story. Oil up, inflation risk up, cuts delayed. But underneath that, it is actually a sorting mechanism. It is a test of business quality. Who can pass through higher costs? Who can maintain margins? Who can keep demand stable even when consumers and businesses become more cautious? Who can fund growth without relying on easy capital? Those are the real questions. And the same logic applies at the macro level. If AI, infrastructure, and large-cap tech remain strong, they can offset part of the drag from tighter conditions. But if rising energy prices start feeding into broader inflation and confidence weakens, then even strong sectors may not fully protect the wider market from repricing. This is why I would frame the current environment in 3 layers. Layer 1 is the shock layer. That is oil, war risk, and supply disruption. Layer 2 is the policy layer. That is inflation expectations, central bank caution, and delayed cuts. Layer 3 is the valuation layer. That is how earnings, multiples, and investor positioning respond. Most people focus only on one layer at a time. They watch oil and call it an energy story. They watch the Fed and call it a macro story. They watch earnings and call it a stock story. But markets price the interaction between layers. That is the real game. And today, those interactions are becoming much more important. For example, Reuters reported that in Europe, bond yields are rising as traders increase expectations for ECB tightening after oil prices moved higher. Markets now see a 44% probability of an ECB hike in April, up from 25% on the prior Friday, and a 70% chance of a third hike by year-end. Even if those expectations ultimately prove too aggressive, the move itself tells you something important. Energy shocks are immediately influencing policy expectations again. That is exactly what higher for longer means in practice. It does not necessarily mean rates go dramatically higher. It means the easy path lower becomes much less certain, and uncertainty is often enough to move markets. The same dynamic is visible in currencies and consumer-linked sectors. Reuters reported that the British pound weakened after US-Iran peace talks stalled and oil surged, with markets also reassessing the Bank of England outlook. In housing, Reuters reported today that U.S. existing home sales fell 3.6% in March to a 3.98 million annualized pace, while the average 30-year mortgage rate rose from 5.98% in late February to 6.46% in early April. That is another reminder that higher yields and higher energy do not stay in financial headlines. They flow into the real economy. And that is why this matters so much right now. Because investors are not just pricing a market, they are pricing a system. A system where oil can hit inflation. Inflation can hit rates. Rates can hit housing, valuations, and risk appetite. And yet, at the same time, strong earnings can delay the market's full recognition of that pressure. That mix creates tension, and tension creates opportunity. For short-term traders, it creates volatility. For long-term investors, it creates a need for discipline. And for everyone else, it creates a very useful reminder. Do not assume one good earnings season cancels out a difficult macro regime. Do not assume high-quality companies mean zero risk. And do not assume oil, inflation, and rates can be analyzed in separate boxes. They are connected. So here is the cleanest version of the thesis. The market still has real reasons to stay constructive. Earnings have been stronger than expected. Large-cap technology remains powerful. Institutions like BlackRock are not blindly bearish. In fact, they are leaning more constructive on U.S. stocks. But that does not erase the other side of the story. Oil is back above $100 in Brent futures. Physical oil in Europe has approached $150. OPEC has already revised down near-term demand expectations because of the disruption. Bond yields remain elevated, and some major firms no longer expect the smooth rate cut path markets once wanted to believe in. That means the real question for investors is no longer, is the market strong? The better question is, how much of that strength depends on assumptions that are now being tested? If oil cools, inflation stabilizes, and earnings remain strong, the market can continue to grind higher. But if energy remains elevated and policy stays tighter than expected, then today's confidence can become tomorrow's repricing. And that is why I think this is one of the most important market stories right now. Not because it guarantees a crash, but because it forces investors to stop thinking in isolated narratives. This is not just an oil story, not just a Fed story, not just an earnings story. It is the interaction of all three. And in markets, that is usually where the biggest moves begin. If you found this useful, subscribe to Market Thesis. The goal here is simple: to make markets make sense, especially when the story gets more complicated.